Well, good morning, Southern Oregon, and welcome back to the Real Estate Show. I'm Alice Lema. I'm a broker here at John L. Scott Real Estate in beautiful Southern Oregon. I'm your host of the Real Estate Show. And today we have a great guest. We have Guy Giles, Mutual of Omaha Mortgage. He comes once a month to give us an update on everything that's happening in the mortgage and lending world. And boy, we could not have him on a moment too soon, because what a tumultuous month we've had, including this week. It seems like this week has been particularly bumpy for a lot of us that are out there in the real estate world. So Guy Giles of Mutual Omaha Mortgage will be on. He'll give us some tips about how to deal with the rate increases. He's got some ideas and some new programs that his company is putting out to help people absorb all these changes. So speaking of changes, we want to talk about not only the buyers that are struggling with these interest rate changes, but how does it affect the sellers? So if you're on the market, we're wanting to be on the market, about to go on the market, listen up, because every time the buyer's monthly mortgage payment goes up, your price point starts to be shaky. Now we're looking at 5% interest rates for those buyers, 5.5%. As of this week, the Fed's predicting soon. 5.5% is a big change for a lot of folks' mortgage payment. In some cases, we're looking at as much as $350 to $400 a month in their mortgage payment. What happens is that pushes their price point down. So if you're selling, then you may have to start doing something different, paying more of their closing costs, adjusting your price, doing a home warranty, doing some changes to the property. You know, we've been in this boat before. We know how to get through it, but they're just changing things so fast. It's a little bit of a shock to the market. So just a reminder, people in recessions still buy and sell houses. So we don't want anybody to panic. Like I said, we've been here before. We'll get through it again, but we got to be ready. So we're glad to have Guy Giles, Mutual of Omaha Mortgage, on the show today. He'll help us with some ideas. And in the meantime, we want to say thanks to all of our sponsors. We've got John L. Scott, Medford and Ashland, our local Rogue Valley Association of Realtors, and Guy Giles, Mutual of Omaha Mortgage. It's going to be a great show today. Please stand by. We'll be right back. Well, good morning, everybody, again, and welcome back to the Real Estate Show. I'm Alice Lema, broker John L. Scott here in Southern Oregon, and we're having our monthly update with in-house lender Guy Giles with Mutual of Omaha Mortgage. Welcome back, Jai.
Hey, thanks. It's a good time to be back talking about everything that's going on right now. I'm sure everybody's—
Oh my gosh, the upheaval in the lender world and interest rates. So why don't you bring us up to speed, kind of what's happened in the last month since we spoke?
Wow. Well, what's happened is I'm having a lot of conversations on rate, especially for people that want to have a house built, or so a lot of these people are 5-6 months out before they're going to actually be into their house. And in a raising rate environment, we do have the ability, that I'm utilizing a lot more now. I'm just locking people in ahead of time. So, it costs a little bit more to have that loan locked for a long period of time, but we can look at floating you down if for some reason, rates do drop down before you close. So those are conversations that I'm probably having more than anything right now. And it's been on, everybody's mind for a little while, because these things are going up. And I mean, it's got to be kind of a hopeless feeling to be in the middle of shopping for a house. Yours is already in escrow, and you hear on the news that the rates are going up every day. And it's like, how do you reconcile that? So really, at this point, we're just spending a lot of extra time with people, saying maybe you shouldn't go to the tip top of your budget, especially not knowing where rates might be 30, 60, 90 days from now when you find a house, or heaven forbid, 6 months from now when your house is built. So just preparing people for, they're going to pay a little bit more, and it just kind of is what it is right now. But
so I guess what I'm hearing then is, if the rates go up too high too fast, what does that do to the borrower's payment?
Well, it's having a big effect on it. To be honest, I've had people come in and we were getting them pre-qualified, 7-8 months ago, and now they're getting really serious about buying a house. We've saved our down payment, and they're in for a little bit of a shock because rates are up all over the place, and everybody's first go-to is, well, let's get online and go find somebody selling a rate. But when I can't say that I'm going to beat every online lender every day, but the vast majority of them, it's almost like a bait and switch where they'll advertise a low rate, but then when you look, you're paying points for that.
Yeah, and I was just going to say that too. And not only that, sellers don't like those online lenders. At least the people here in Southern Oregon, they don't like online lenders.
We had an example just last week, where there was a guy. It actually happened 10 days ago because we got it closed in 10 days. But he was a guy that decided to go to a big bank, and just because he could find a arm that was just a little bit cheaper. Well,
and that's an adjustable rate mortgage, not an arm, right?
Yeah. Yeah, they arm and a leg right now. But he ended up coming back and saying, "Hey, I'm sorry," and we didn't blame him. It's one of those deals where you're trying to do the best thing for your family, and he thought he could get a better rate. Ultimately, not only did he not get the rate, but they denied his loan. So we had to go back, get an appraisal, ended up getting the thing done in 10 days from start to finish. And there's no way that a big bank could ever do that. And it's not that our rate was bad. They just saw something shiny and decided to go for it. And the sellers were agreeable to switching over to him, and then they were really agreeable when they came to switch back. But it's just like I've always said, what the big print giveth, the little print taketh away. So you just have to think a little bit about who you're dealing with. If somebody's getting paid $14 an hour to originate loans, they may not have the knowledge to go in and find out what really is the best deal for you. They're just kind of adding in some things, and sometimes they work out and sometimes they don't. And if they don't, they have another 1,000 people in line just kind of ready, waiting. So they'll just ignore you and move on to the next one.
Well, and it's kind of a precarious time right now. I think if the market were steadier, then people have time to really delve into what each different company is offering legitimately or not. Right now, jumping to those online lenders, it causes a lot of commotion in the transaction. A lot of them don't close. They're very non-communicative. And I'm just speaking as a broker. We have a really hard time. And then our sellers, especially if you're in a multiple offer situation, if they have anybody else to choose from, they'll go with that. So it's not like we're just promoting, our local lenders for the sake of promoting lenders here. It's that there's a real side effect if you don't have a local lender.
Yeah, and I mean, it goes all the way down to the appraisals, to everything. I mean, if you find something online and it's apples to apples with what you can get locally, yeah, if you're buying a product or something, as far as something tangible, you might get a little bit of a better deal sometimes. But on a service industry type thing, we've done some research, and it is amazing how many kids are just doing it for a term while they're in college or while they're on their spring break, and they're getting in. They're smart kids, so they're getting licensed really quick. But
you're talking about the online people.
Yeah. And until you've dealt with a low appraisal, or you've had to, do some lender paid mortgage insurance, or just kind of manipulating things to find out how you can actually save people money, by the time it's all said and done, a lot of times it's not a better deal anyway. There's points hidden in the back, or they call it, something else. And anyway, it's always good to at least check with us. And I mean, if I'm legitimately getting beat and you're really, really solid, and we're talking, I'll tell you, you know what, you're so bulletproof that you might be just fine, to do this. But if you're self-employed, if there's any hair on that deal at all, it's really good to have somebody that you can sit locally with and and get upset with locally if we don't perform. Those guys will just be gone, and they're probably back in school or recess is over or whatever. So
Yeah, or they just don't take our calls, But
yeah,
yeah, the communication channel is important too when you are dealing with lenders. So keep that in mind as well. So speaking of appraisals, what's happening with appraisals now?
well, it seems to me like everybody's moving towards desktop appraisals, and
Can you describe what that is?
yeah, so an appraiser right now, and I don't want to speak for all of them because I don't know how many appraisals you can do. I mean, I've talked to a few of them, but say an appraiser can get 2 or 4 appraisals done in a day or in a week. You're driving around, you're doing all of the due diligence to get the thing done. You're taking pictures of other houses. Um, they're coming out with these desktop appraisals where I think we're going to see a lot of pushback from the appraisers at first on it, and I've already heard some of that. Gal that works for me, her best friend is an appraiser, and he's just like, no way in the world. But what'll happen? I mean, I think the biggest benefit to these things are rural properties that appraisers really don't want to go out and appraise anyway. They do because they're professionals and they understand that they need to be done. But you're not going to get somebody out to Roosh day after tomorrow to appraise a house, no matter how cool they are. And if you do, you're going to end up paying double, triple for that appraisal. So with these new desktop appraisals, you could actually FaceTime with the appraiser, and that appraiser will say, hey, go look to the left, look to the right, let's go in this room, let's do it. And there's
Really? That's what they're doing?
that, yeah, that's the technology that's coming down the road. And they may have hiccups with that technology to start with. So, I don't know that this thing is going to be fully implemented overnight. But the reality is, they want to make sure they have a saleable house first and foremost, and what the value is. And especially in subdivisions and things like that, a lot of this can be done, without physically going out there. So they're talking as much as like the realtor or the lender could be the one on the other end of that phone and showing the appraiser, and they might be able to get 12 or 15 appraisals done. Again, we don't know the math on the technologies and things they're going to have to use, but we've been told that you could cut these appraisal prices as much as in half, and the appraiser will actually like it in the long run because they're not paying, branding gas prices at $7 a gallon, to run around. And if you can get 11 or 12 of them done in a day, you're going to end up making the same amount of money. And really, we're just here to serve the clients. And taking a long time on an appraisal because they're so buried, isn't helping anybody. So I guess we'll see where it's going, but that's what we're told, and it's already started. So
Well, and the shutdown, during the shutdown, we had an awful lot of lenders do that.
yes, yeah, and documents is another thing that we are. We're at the point now. I personally like the title company. I like to go down there and I like to, visit with my clients and do it. But they're, at this point, we can do all of the docs except for a couple of notary ones, just right over your phone. And then the notary ones, now they're enabling that to where you can do those on a Zoom call with the notary.
Wow.
So I think the one place that could actually help quite a bit would be our remote signings, where you have a seller that's out of town, a buyer that's out of town. I mean, you could do it from the beach in Hawaii if you're on vacation. I mean, how many times is there a checklist? And it's like, I got to wash my clothes, I got to pack, and I've got to do a mortgage before I get on an airplane. I mean, it's almost like it's on their checklist. So, dealing with those kinds of situations, I think it could really help. And especially when we need the documents, here to record, being able to do all this stuff electronically, you're not going to hopefully lose that day getting those paper docs back to the title company so that they can locally record. And because that's so new, I don't know all the details on that, but all of this stuff could actually help as long as we don't make the whole process too impersonal, because then we might as well just be that online lender. And I always like to meet with people face to face and just go over their options, because you just lose so much in email and text message. So
And
Anyway,
it still is a people business. There's a lot of humanity that comes into play because a lot of the real estate purchases and sales are driven by life events. So yeah, I think it's still a very personable business, but it's interesting. The shutdown taught us so much of what we don't need to do. And I think the appraisal world this is the outcome post Corona, sort of
yeah.
post Corona, that they don't have to go back to work the way they did.
Yeah, well, and maybe the answer is somewhere in the middle, where instead of having to do a full appraisal on everything or appraisal waiver, that it's somewhere in the middle, and then you're verifying a little bit, but it's a lot cheaper for most people. And then, and you're getting at least something for the other ones. So maybe they pull back a little bit on the complete, just appraisal waivers, and then pull back on the complete full appraisals where the appraiser has to go out. And then you're just maybe looking at $400 for an appraisal, and said and done, and somebody actually went out and did it.
Yeah, that would be. Well, folks, we got to take a quick break. We're talking to Mutual of Omaha Mortgage's Guy Giles, our monthly check-in with the in-house lender. We'll be right back after a word from these sponsors. Don't go away. Well, welcome back to the Real Estate Show, folks. I'm Alice Lema, broker John L. Scott here in Southern Oregon. And what an interesting conversation we're having today with Guy Giles, our in-house lender with Mutual of Omaha Mortgage. And we were just talking about the technology trend, I guess we'll call it, where appraisers are not going out to the houses themselves directly anymore, and some of the side effects of that. So before the break, as we were talking about that, Guy, one of the questions that comes to mind is, if they're not actually going into the house, how do they know it did not get trashed or it doesn't have damage?
Well, I from what I understand, and this is literally new as of about a week ago, as far as actually implementing this program. So I haven't actually personally done one, but they're looking at just doing FaceTime, where the appraiser is going to actually be able to see everything in it. So I don't know if it's the agent that goes out, if it's the lender that goes out on these, who is actually running around doing these things.
If that's the case, then who has the fiduciary responsibility to make sure that everything gets shown to the appraiser on the phone?
It would most likely, and again, because it's so new, I haven't done it yet. I mean, I could see that on an FHA loan. What lender would point the phone to that peeling paint on the fence? So I mean,
well, they should, if they have integrity.
Well, yeah, but I mean, I would, but those other guys would. So anyway, but I mean, there's naturally going to be, trying to do that, but it's just going to be the appraiser that's directing, I guess, what's being filmed, and there actually might be ultimately better documentation for the kind of shape that the house is in if the whole thing is on video rather than.
Oh, that's a good point.
Yeah, I literally just thought of that right now, so I wasn't. But yeah, I mean, they're really looking around, making sure that there's what's called a saleable house for Fannie Mae, Freddie Mac, or whoever the investor is that we're selling to. So it actually could be a better documented, piece of paper.
That would be interesting.
Point. And it I mean, there's no reason to believe, and this is what I've heard, that the appraiser will be directing, where that camera is going and what you're looking at. So it's not like you're going to be able to just be in the wrong house. They'll use GPS to make sure that when that
I didn't even think of that.
Yeah. I know it's not really a single wide. It's actually, yeah, but they'll track it by that also, just to make sure that you're actually standing in the spot when that thing's being filmed, which that's a little Big Brother-ish for me too, to be honest. But at the same time, I think everybody's going to be really reassured that these are actually good appraisals. And if, you walk over and you turn on the stove for somebody, it'll actually be on film right there that the thing lit up.
I wonder if that'll open up a new employment opportunity where, and I'm just thinking out loud, there might end up being some kind of certified appraiser assistant that has a responsibility for doing these intake videos. So the principal appraiser doesn't have to go. I don't know. We're just making this up. We're just talking, folks. But technology is replacing humans in our house sale process here already.
Absolutely. By next time, we will be we'll be deeper into this, and I'll have a lot more information. But when you talked about a fiduciary responsibility, you also have make sure that oven gets turned back off. You know what I mean? It's like you are just sending somebody out that doesn't know what's going on. I mean, I wouldn't want to leave my house so someone could do an appraisal and come back and all the lights are on and the front door's wide open. So there are things that will have to be worked out on this thing. But it's coming. Some of this stuff's coming, whether we like it or not.
Yeah.
And really, we just want to write good loans and make sure that, my side is the buyer, that they're getting well taken care of. And, beyond that, if we're able to do that with these, then I'm all for them. And if it's not working out, I don't see any reason why we couldn't order regular appraisals.
Yeah.
So,
well, it's interesting side effect of the shutdown. We're coming out of all that, and there's still some residual habits that we acquired during the shutdown. And there's some that people don't want to let go of, like remote working. We've got people who just don't want to go back to their buildings, and that is having an impact on house sales because of the kind of properties they want now, and also the location. They don't have to live near their work hub. It's really quite interesting.
No, I know a lot of people that are spoiled, not spoiled, but I mean, if you can legitimately function and do your job from home, why not? Why not? I mean, people want the environment. If you're burning less fossil fuels. I mean, I'm a guy that thinks we really do need fossil fuels right now. Don't get me wrong, but I mean, I don't care if I got a thing on my roof and it's generating my electricity. I'm all for this stuff, and who knows? Maybe that helps a little bit in that area if these darned appraisers aren't driving all over.
Yeah, that could be. It's a good point. Well, it's just very interesting how technology is creeping into our everyday lives. And when that announcement was made, like you said last week, that the
FHFA.
It's too many initials, and that stands for
Yeah. See, now you threw me on the spot.
Federal. Oh, sorry, no, but it's Federal Housing Agency.
Now you just.
Really but anyway, it's the pseudo government.
This is
oversight, and they announced that they were making permanent the opportunity to have what's called desktop appraisals, which is where you don't have somebody going into your house, and so you get a phone call when you're buying a house and it says, oh, we just waived the appraisal. That's what they meant, right?
Yeah. And well, that's a little bit different than that. And it's the Federal Housing Finance Agency, by the way.
Thank you, Federal Housing Finance Agency.
Drew a blank. So we've had these appraisal waivers for a while. So if Fannie Mae or Freddie Mac might have had that house sell 3 years ago and they have a full appraisal on it, and they're really comfortable that that nothing went down as far as value, we've been getting appraisal waivers for quite a while.
Oh, so that's different, is what you're saying.
So yeah, this is something different where it's actually going to be the equivalent of an appraisal, but it'll be just done from their desktop. So that's what I mean about those waivers are just like, that's it. We're not doing anything on it.
Oh, so that means they're not even doing a desktop.
Gotcha. No. Yeah. This is something kind of in the middle as far as that goes. But it will be pretty much a full appraisal. Just the appraiser won't be actually driving out there to the house. And like I said, there will be resistance, but I do believe at some point they'll embrace it because they won't have to go all over the place. And how they reconcile the filming piece of it, they've told us, but we will just see as they happen, and they're starting to happen right now.
Yeah, well, it's just an interesting age. Interesting age.
I mean, I did want to touch back on, earlier with the rate thing. I mean, I've had some awesome people doing, right in the middle of a loan, and well, not in the middle of a loan, but now they're getting locked in. And these, we're about a point higher than we were when they started looking, a month and a half ago. So there's a lot of sticker shock when it comes to this. So I just want to make sure that people are really aware that rates have gone up. And if you're pre-qualified for a certain amount and now you're really starting to look, call your lender and find out, what has changed. because there's people that I haven't talked to in a year, and all of a sudden they call back and they say, hey, now we're ready to shop. And you really want to have that conversation with them. We've actually been starting to get proactive with people, calling them up saying, hey, some things have changed and we should talk. And it's not so we're trying to get you in here to with any motive other than I don't want to get a phone call that your house is sold and I haven't talked to you in a year and a half, and now you're expecting where we were then. And it's
Well,
just
and that's the problem. People don't realize the rates are 5% or more.
yes, all day long now. And
It's shocking.
it happened really quick as far as that goes. The Fed's balance sheet right now, as far as the mortgage-backed securities, is right around $9 trillion. And just to kind of put that into perspective, if you counted seconds for a million, it would be, well, like 11 days or something is a million seconds. It's 39 years for $1 trillion. I mean, it's a big jump. And we just get so used to seeing these numbers as these guys write these big checks, in their stimulus bills and all their things. That's where this inflation comes from. I mean, we have more dollars circulating right now than we did. And that, you can't really get more simple than that. And we have to get a handle on it, because it just doesn't seem like anybody wants to rein it in right now. And there are real effects, and mortgage rates are just one of those.
Well, and it's, people said we have to slow down the economy. That's what all the bigwigs said. We need to slow down the inflation. And so part of that means lowering the prices of houses, sort of. I mean, that's not the only thing that's going on, but in order to stop the rising prices in general, this is what they're doing. So we do have some people that are trying to sell their house that are doing really big price changes now. And we have other people that are just taking their house off the market because they don't want to play ball.
Yeah. Well, and if you got locked in with a really low rate before, that's the other thing you're staring at, is going into another house with a higher rate.
So do you think that a lot of people will just not sell their house now because they have such a good rate and they're not going to be able to get that rate for their new purchase?
I think it's just going to come down to the motivation. Like you said, if people are working from home and they do not have a good spot to work from home, maybe it's worth it to pay a little bit more to be in that house that you're comfortable with, that you can, have that family time that maybe people weren't having pre-pandemic. So, it might be worth it, especially if somebody's concerned that there could be another lockdown. And I pray that never happens again. I mean, locking down healthy people is not a historical precedent. And
but the other thing is, I think there's a lot of people that are worried about that because there's still outbreaks overseas, and we don't have a lot of conversation about that here because it doesn't sound like it's affecting us here. But if that does happen again, I think it will liven up the housing market, because anybody who wanted to move and then didn't because it was all kind of okay again, that's that desire, like you said, to have more space, especially if they're working from home, is going to creep back up to the top of the list.
Yeah, I don't know how long we have before the break, but I do have a thought.
We've got 1 minute.
Okay, well, think about all the people that have still been locked down in California until very, very recently. These guys aren't moving around looking at houses. So we have spring coming up. We also have all of those people, I would believe, that are still kind of, pent up. I talked to Facebook workers. I've talked to all kinds of people during this that were doing it in a very, very small apartment where they weren't even opening up the parks for them to take their kids to play. So
wow,
I would think that there'd be some sort of another rush now that everything's happening kind of at the same time, at least for areas like this where you can still at least see a mountain out the window.
Yeah, a lot of the Google employees in the Bay Area, we're starting to get calls from them. So you could be onto something there, Guy. That might be your prediction.
Well, I think so. And I'm predicting lower rates down the road at some point, by the way.
Really? Wow.
Yeah,
So we should talk about that in the next segment. We do have a break coming up. Guy Giles is making predictions. The rates might go down. So we've got a quick word from our sponsors. We're brought to you by Mutual of Omaha Mortgage. Guy Giles, thank you. John L. Scott, Ashland, Medford, and our local Rogue Valley Association Realtors. We'll be right back. Well, hello again, everybody, and welcome back to the Real Estate Show. I'm Alice Lema. I'm a broker here in Southern Oregon with John L. Scott Real Estate, and we're here visiting with Guy Giles, our in-house lender of Mutual Omaha Mortgage. So much going on in the financial world. It's just hard to know what to talk about next. But Guy, right before the break, you were talking about interest rates possibly going down. What more do you want to talk about? That's an interesting idea.
Yeah. Well, let me preface my whole thought with historically what has always happened is we get inflation, and then eventually the yield curve. I won't go too deep into it, but it has to do with the 10-year and the 2-year treasuries. They kind of invert where you're actually making more money on the short-term stuff than the long-term stuff. And what ends
Has
up
that
happening
happened?
Well, yes, this week actually. So it's touching and it's kind of coming off and going back. And yeah, this week we're actually there. So generally what happens is the Fed raises rates at that point, and then it throws us into a recession. So people are starting to talk recession. I've been saying it for, I don't know, a year now, 8 months, something like that. But what'll generally happen is that'll happen. It'll cause a recession, and then rates will drop back down. The one dark horse, the we can't really predict is what the Fed is going to do with the mortgage-backed securities. So when they really stepped in was after 2008, 2009, when the big crash happened. They jumped in. It really spurred low rates. They were buying them, and then as those loans would get paid off, they would reinvest that money back into it. Well, they've been talking about tapering this thing down for a little while. At this point, there's about $9 trillion that they own on their balance sheet as far as these go. That would be the one unknown. But historically, what will happen is we'll get thrown into a recession, and I would think by the fourth quarter or the first part of next year that we should see a little bit lower rates. I don't know what happens between now and then. I think the only way to really buffer yourself is we can lock people up to a year on a house.
Oh, that's good.
Yeah. And we just put this in where we're doing a lock and shop where you can come in and say rates are 5% this morning. That's a little lower than the regular, what we call par rate. And I can talk about that more some other time, but we'll give you just a slightly higher rate than that. And you're locked. So you're out shopping. You don't have a house picked out, but you're out shopping for a house, but you know where your rate is. So you know what you're looking at, and you're not worried every morning that you get up to go look at houses. And as you're getting dressed, they're talking about the mortgage rates going up again.
Yeah. Cause that's terrifying.
Oh yeah. Yeah. I get to hear those stories all day long. And again, I was just dealing with one today, and just a wonderful woman that, has done the right thing, has over 800 credit score, 30% down. And I actually shopped it around with about 13 different places, and still both of us were just kind of standing there with our mouth open. It's like, what did we do wrong? You didn't do anything wrong. It's just where it is right now. But if rates go down while you're in the middle of that, we have you locked in. We don't, on this lock and shop, we're not going to charge you to float down your rate. So 3 weeks into it, all of a sudden, heaven forbid, a terrorist attack or something, and the markets get spooked, we can float you down into the lower rate, and we don't charge you for that.
So there's another practice I remember from the other high inflation time of the 70s and 80s. It was called buying down your rate. Can you talk about that? And is anybody doing that yet?
Yeah, and if you go to online, that's what you're seeing all the time. You go to Quicken Loans, they will show you a rate that, if you call me and say, what's your rate? Well, I'm doing you a disservice, first of all, by telling you a rate, because there's about 26 things that go into quoting an accurate one. But if you ask them their rate, they'll tell you a rate and an APR, and they're always baking points into their quoted rates on there. So points are,
okay.
You could take the word point, throw it out the window, put the word percent in there. So if you're paying a point on a loan and it's a $400,000 loan, that's 1% of that rate.
So that's $4,000
for that loan. Yes. Yeah. And in these instances, you're paying 2, 3, 4 so that they can throw up that big teaser rate right there. and you could be paying 3 or 4 points. So then you're looking at $12,000,
Okay,
$16,000.
so does that mean that in that scenario, a borrower can give the lender an extra 10 or 12 grand and their interest rate will be lower? Is that what
Yeah,
you're saying?
yeah, and that goes back down to looking at people's goals, because if you're going to be in your house for 4 years, that's never going to make sense. If you're
No, but if
legitimately,
you're gonna keep it
yeah,
for a long time.
yeah, and no matter what you pay, it will pay itself off eventually, but you don't want to be a hostage to that either. If you're paying too much up front, and now all of a sudden, somebody, I don't know, you find the house of your dreams 3 years from now, and then all of a sudden you want to move, and you're thinking, man, I'm going to be in the hole for 12 years paying back these points. But as far as the actual term, banks can give you whatever rate that they want. It's just what that money costs.
How
So
do they get you to that rate? That's the
yeah,
secret.
so
Gotcha.
so what we call a par rate in our business is basically just not paying any points, origination fees, things like that. But I can actually give you a higher rate and give you money back, or I can give you a lower rate and charge you money. So, sometimes when you're negotiating with the sellers, and maybe this is something that people start getting more creative on now also, is the seller's a little worried about selling their house because inflation. Well, maybe they're paying some of the points for you to buy down your rate to be able to get in the house.
So
And
that
then,
would be a credit to closing costs.
yeah, and
Yeah.
they, so I mean, there's a bunch of different ways that those could be paid for, but that's really what it is. It's like if you're paying points, you're just basically buying down, getting a little bit of a cheaper rate, and paying a little bit of money for it. So like I said, I have actually gone the other way where somebody's like, I'm 2 years from now, I'm going to be out of this house. Well, maybe you don't want a lot of skin in the game at that point. So we do what's called rebate pricing, where we give you, who would talk about this in this environment, but a worse rate. But, we're covering a lot of the costs associated with the thing for that. And
Mm-hmm.
it's just a matter of how long it takes you to either realize, the money back from what you paid, or vice versa. So it's
Well,
just a
and
good conversation
I
to
think
have.
people don't really realize how intricate this lending process is. And when they get objection from the sellers they're writing offers to about these online lenders, that's part of it, is because there's so many variables like you're talking about that can be used to help put the deal together, keep the deal together. And when we have all of this volatility in the market, I think you really do need somebody here locally who can help you through all that.
Somebody that's accountable.
Well, that too. Here
I,
and accountable. Yes.
yeah, I mean, I've seen a lot of those where somebody says, hey, they're only charging me, $6,000. In reality, they only quoted them 2 months of taxes, but not realizing that we collect 11 months of
Well,
taxes.
I've had people come to me and say, here's my great rate and my payment, and there were no taxes in there. And in
Yeah,
Oregon, Southern Oregon, the taxes are high. No offense to our counties, we love you, but the taxes are high.
no, that's absolutely true. And that's another conversation. I know we got less than a minute here, but you could have two identical houses in the same subdivision. One guy pulled a permit and the gal next door didn't when they upgraded their houses, and one person's taxes are way higher than the other. So just be real mindful of
Well,
that.
and just a side note, I'm in the middle of something messy like that now, and we're afraid that the deal's not going to work because nobody wants to put it up to speed so that the county will permit it. So listen, folks, if you're going to do something to your house, get it permitted. Guy Giles, Mucho of Omaha Mortgage. We got to say goodbye. Can't wait to talk to you again next month. Have a beautiful weekend.
Hey, thank you very much.